Hi, everybody. Look, I'm lucky enough to have Amit Valentine from Luval Financial Services. Amit, thanks for joining me.
Thanks, Jen.
Yeah, very good. Yeah. Look, mate, it's been a while. We caught up recently, but full transparency for everybody. We actually used to go to high school together.
Yeah, absolutely. So we're all high school mates, of course, from many years ago, close on 25 years now.
Yeah.
And look, it's quite a surreal feeling to reconnect. And it's funny, people don't tend to change. It seems to be, no matter how long time passes, we all stay the same in a sense.
Yeah. From memory, we had similar classes together from like economics, business, commerce. I think we shared the same math class for a period as well. But funnily enough, we've carried that through into financial services later on in life.
That's right. So my background actually was initially in accounting, funny enough, and I've stayed close to the finance and the space of helping clients on their finances by transitioning to mortgage broking.
Yep.
Yeah, and look, I think even just some of the work we did with economics back in the day, I think really plays into both those industries, especially in our space as well as in property as well.
Yeah, look, it's going through a bit of a transition period as well. But if you have a look at the economic life cycle, even since we left school, dot-com bubble in 99, then we had the Olympics boom in Sydney after 2000, 2001 onwards, GFC, we've had the financial downturn, 2017-19, COVID. We've seen like all these economic life cycles over the last 25 years that we've been able to experience as well.
That's right. And so I think that in itself is a lesson. It gives you a chance to observe long-term trends and see what really matters in the long run. So I think, especially now with what's happening, and we'll get to that in due course, but people are starting to understand that what exactly are the fundamentals we're looking at and how can we grow our portfolio organically, right? So that's what people are thinking now.
I think it's not only about growing your portfolio as well, but more particularly in your field, it's about helping people realize their financial goals through finance as well.
Yeah. Yeah, so maybe it's a good opportunity for me to mention my dad has been in mortgage broking for 25 years now.
Yep.
And so when he got into broking, he was starting from the get-go, building relationships really organically. There was no sort of lead companies and so on really at that time. He was really working through a referral basis, and he would get to know every person, every single client person.
Yeah.
He would go to their house and he would get to know relationships they have and then grow as they grew as well. So that was a very important part of how he built his business.
Yeah, so it's almost a generational mortgage broking business or a generational book of clients that you have.
Yeah, that's right. So I work with a group of people, great group of people now, including my wife as well, who's joined the business. And an interesting story is I've got people that my dad had built relationships with. Their kids are now in their 40s, same as us. And,
Yeah, wow.
And they're now reaching out to my dad and saying, what's the transition plan? And obviously with us working very closely with a number of clients in that property space, it's a natural transition. And again, that trust transfers right over because we understand their family and how they've grown, and they also understand our business quite well.
Yeah, okay. Yeah, and at the same time, you'd experience people's needs at multiple life stages as well, from first-time buyers to wealth accumulators to pre-retirees to even later on in life as they retire and settle down.
Yeah, and I think that's one of the things, people's situations change over time. And I think when we're looking at, we do see some brokers in market are more volume-based, and they're, of course, looking for a quick win, perhaps, and they don't think about what's the next step and the step after that. Many times we're having to do it in stages, so we can't actually get to where we want to in one go. So we have to think through, okay, so where are we at now, and how can we plan that forward? And sometimes that can also include looking at things like their cash flow situation. How can we manage it until that point? Are there any areas of their finances they're not perhaps managing as well as they could? And obviously there's a point where they need to take some action on their side, but we offer pointers on what we've seen with how people manage their finances to get to a second point where they can obviously take that next step as well.
Yeah, because look, I say to people all the time, like any mortgage broker can get you into debt, but like a good mortgage broker will help you achieve your financial goals. And so it's important to understand not only what are you looking to do, but like what are the goals that you're looking to achieve and how can I help you?
Yeah, I think it comes back to how can we use leverage as part of a long-term strategy. So no one wants to intentionally get into debt.
Yep.
But having said that, the way we build wealth in Australia, even with the changes that have happened now, it's still going to be through property.
Yep.
Property is still seen in Australia as a very sound strategy. If you're parking your money, say, for example, in a term deposit, or you're parking it, perhaps you're leaning into the stock market, perhaps you're more susceptible to changes in the short term and also fluctuations and headwinds that you will see not just locally, but also internationally as well.
Yeah.
Property, if we look at the trend lines over the last 20 years, we will see that has trended upwards. And that's some of the fundamentals that we can lean on.
Yeah, nice. Yeah. Look, I think regardless of tax reform budget changes, the overwhelming supply and demand fundamentals are clear as day. We're not building as many properties. Net overseas migration has been so high over the last few years, and we're not building enough to catch up with that number as well. So that being said, if you just look at simple supply and demand, economics 101, the capital value of existing property is going to go up.
Yeah, that's right. And look, there's a lot of noise in market now with a lot of, obviously you've got different sides of our political spectrum as well, and they will have their own spin on what they think this means. And you've now got three potentially prominent parties that have their own voice. But ultimately it's about stripping it back and something as simple as supply, right? So I was actually talking to a client today and we were discussing just the central problem, really, that hasn't been addressed, the supply issue.
Yeah.
So if we can find a way to address the construction costs and the plus that goes into what people are paying for new builds, that's a systemic, really core issue that we need to address before we can really move forward as a market, I think.
Yeah, I think a lot of people are faced with a choice whether to go existing or new at the moment. And the case to buy new just isn't there. The budget does seek to remedy that by enticing people to buy new through those tax incentives. But I just think once you buy that property, those tax incentives don't carry on. So the luster, the glow of a new, shiny new property will wear away very quickly. Number one, because those tax incentives don't get passed on to the next person. Number two, because I don't think the quality of those new builds are just there. Typically, they're in high density locations. And then those high density locations, the value is diluted by the overwhelming supply of property in those areas. So that exceeds demand. And then the other house and land packages typically they're built out in the sticks, out in the middle of nowhere with no surrounding infrastructure. And often there's a long commute to the CBD or wherever your place of work would be, or school, or whatever infrastructure. It's just not there. So there's a big problem with buying new for those reasons.
Yeah, totally. And so what we're finding, and of course the government's intention was to bring in that first home buyer market, and surely that will be one of the potential positives that come out of it. One is the mum and dad investors that perhaps not only were looking to increase their portfolio, but also upsize their current property. It brings them back into that market for that existing home space. And so there's opportunity for us that are in industry to really seize that opportunity with our clients and work with them on what that means for them now. And maybe it's not an opportunity right away, but I am starting to speak to clients, especially now in the run into the end of the year, where they're thinking, okay, there's likely to be an opportunity now for me to get into market. How can I look at my finances? Is there some planning I need to do from my income perspective to get to where I need to, such that my borrowing capacity does stand up?
Yeah.
There's been a lot of focus on borrowing capacity, of course, with the negative gearing changes. But I think what we find is that if we can do that adjustment now, they'll know what they have when they hit the market. And of course, then obviously from your perspective, it's about then readjusting their expectation and understanding where they can focus.
Yeah, 100%. And I think predominantly in Australia's two biggest and most expensive cities being Sydney and Melbourne, I think Brisbane's actually caught up. But we're seeing house prices pare back, and that's mainly because investors have left those markets, number one. But number two is they're overly unaffordable at the moment. And then given inflation and interest rates and lack of wage growth over a period of time, people just can't afford to pay those property prices anymore. So look, in that respect, yes, like I think a lot of mums and dads are in the opportunity where they can upsize now. Like property prices will fall back to a level where they're comfortable for owner occupiers to now get into the market, or where first home buyers can get into the market. But then also where investors can see it's worthwhile, it's a little bit more feasible here as well. And so with that being said, they'll meet borrowing capacity standards.
Yeah, 100%. And I guess it's a good segue into, in such a market where you've got a number of advisors that are involved in your finances. Typically, you've got your buyer's agent, you've got your mortgage broker, your accountant, and others as well. Some of that interfacing between these professionals, I think, is an important part of that. And again, it's something that it's been in our ethos at Luval. We always try to do that. Personally, obviously with my accounting background, I'm trying to maintain a level of what would a dream look in terms of what the accountant would want to see in terms of how the finances have been organized and arranged for this particular client to make their life easier. And so I guess in terms of the buyer's agent and mortgage broker relationship, I just want to get your thoughts actually. What are your thoughts on how maybe you've worked best with mortgage brokers?
Yeah, look, it's essentially around what is the goal. So look, typically the mortgage broker would come to me and say, hey, I've got a client. They're looking at purchasing this property. This is what we're doing. And then these are the requirements associated with borrowing. And then we just keep them up to date as to how the purchase is going. So we'll say, hey, we're looking in this area. Properties of this type have these sort of fundamentals. And they just make sure that it's acceptable to their borrowing requirements and the lender. But I typically work more with an accountant and financial planner prior to that as well. So look, typically what we do is the accountant might come to me and say, hey, look, client needs to looking to buy a property in this entity, and the purpose of this property is to do this. It might be capital growth, it might be passive income, it might be to help them build a lifestyle in retirement. But it's predominantly about the goal, and the conversation with the accountant and financial planner would be similar. It's like, what is the goal? And we work our way backwards to their current position. So it might be a couple of properties, it might be one property, but yeah, essentially we work towards a goal. Yeah.
Yeah, and some of the finer points when you're dealing with maybe those that are newer to the industry, perhaps, is they might miss. There's things like policy elements, which if we're looking at, for example, for a broker, we've got best interest duty as no, and it might be we're looking at a couple of options, but that three options, it may only be actually one because the policy mitigates us going for a certain type of property, perhaps maybe a certain type of zoning, for example, and strong knowledge of policy. Have you had any examples of cases where maybe you've seen in market things that have been not going so well? And I've got one story I can think of. I'm sure you've got a couple as well.
Yeah, there's tons. A lot of people think, prior to the budget reform, yeah, I'll buy whatever and I'll negative gear it, but they don't really think about the cash flow associated with it. Unfortunately, 18 to 24 months later, the like interest rates have come up, all the underlying expenses like council rates and insurance premiums have come up. The property's sat vacant for 3 or 4 weeks, and I can't stomach the cash flow anymore. I can't bleed any more money, literally. And so I've been forced to sell it. I've seen a fair few of those. I've actually seen a few first-time buyers think that they'll just buy like a 1 or 2 bedroom apartment in a high density area. I'll just buy this off the plan. It'll be easy. Strata starts off at $1,000 a quarter, and then all of a sudden it triples. And then there's a special levy on top of that as well. So I've seen a fair few of those instances. Yeah. What about yourself?
For me, it's been also around, it's been misconceptions around what they've seen us in market and on the news and so on. It's been more about translating because right now you can jump on to any comparison website and you can see the lowest rate, and it's tempting for buyers who maybe want to do their own research. If you look at even say the tech industry and how people are buying tech now, it's very much you do your own research first. And so if they take that same approach with property, sometimes the challenge is that there aren't tools available, but what they don't tell you is what it looks like in maybe 2-3 years from now. It could be a temporary rate reduction for the first 2 years. What about after? What if their situation changes as well?
Yeah.
So there is a little bit of a trap I'm finding where people get locked into the scenario, and unfortunately it's hard to unwind that in some situations because obviously there are costs involved when you're making changes. You got to think carefully before you make your next profit.
Yeah, 100%. Yeah, and I just think people need to have that sense of financial literacy about them. You don't know what you don't know. And I'm sure people have tried to go on ChatGPT or Google and just say, where's a good area to invest? But I think there's a few questions that come before that. What is the purpose of you buying a property, and what are your goals essentially, whether it be owner occupied or investment? And then a big one for me lately is the stigma associated with rent. Coming from ethnic background, renting is seen like a little bit of a mark on you. There's a certain stigma associated with renting, but I think renting is actually a very intelligent thing to do because you're managing your cash flow at the end of the day.
Yeah.
And if you can build assets on the side, you're actually allocating more capital to investments, into growth assets or income producing assets. And then those income producing assets buy more income producing assets. And that's how you get compound interest and capital growth and all that sort of stuff. Yeah.
I think that's just a mindset thing.
Yeah.
Investing, I think there's going to be more people over time that probably look into that a little bit more deeply. And so I'm definitely seeing a trend of that. I did have one client actually, particularly that went to that strategy and found that they wanted to also, it was part of a multi-pronged strategy to also unlock their SMSF as well. And reinvesting can be something, especially with the new generation coming through. We're hearing a lot of younger people feeling like they're not able to enter the market. But this is now a genuine opportunity for them to build wealth and rent, and it allows flexibility as well, right? They might then have kids and they need to go to school, they need to get into certain catchments perhaps, and it allows them to move around, but also have stability in the way they build their wealth.
Yeah. Look, I'd have to admit about a third of my customer demographic are rent investors. And then over the last sort of 3 years, we've been purchasing property with that in mind, say rent where you want to live and invest where it's smart to do so. Because especially here in Sydney and in our other capital cities, rental yields have just compressed. And I'll give you an example, like I've been a rent investor since 2018 myself. I've been renting here in the inner west, and the property I'm living in is probably 2.5, maybe close to $2.7 million. But I rent it out for not even 2.5%. It's just over 2% in terms of rental yield. And I think if you have even $1 million in debt on there and you're paying 6% interest rate, that's 60 grand a year just in interest, let alone the council rates, water rates, land tax, all that sort of stuff. And I think that the rent I pay isn't even touching the sides, and you expect me to buy it. So for that reason, I don't think certain areas, especially in capital cities, are great investments cash flow wise. And I hate to think you need to be like a high net worth individual to be able to bleed that sort of money for years on end and hopefully, fingers crossed, achieve some sort of capital growth.
Yeah, I think the whole talk around intergenerational equity, and obviously now that there's this sort of re-look at our mindset around building wealth.
Yeah.
And I think this is a very important time to look at all these. I've seen a lot of influencers online, and I'm sure you have as well.
Yeah.
And some of them are quite perhaps scarred by some of the government's, rhetoric around the narrative around certain changes, maybe how quickly they've been made.
Yeah.
And now obviously we're seeing consultation after some of that policy comes out. But I think it's going to, I'll give you an example. I'm sure you've seen MFAA, which is one of the broker associations, put in a long and lengthy response to the initial round of changes that the government brought through. And after that revision, obviously we had further changes and concessions around the term limits for businesses, for example. That change was made on the back of that long submission from the MFAA. So we're seeing more consultation, albeit after the fact. At least it's getting key bodies involved in a very core and important conversation. As we know, these changes have been probably the biggest in the last 20 years. So it's important we do that. And I think that will filter down to the consumer level as well.
Yeah. Look, there's a lot to say about business sentiment. And yes, the turnover threshold was increased from $2 million to $10 million. But I just think that the budget reforms have a bigger impact than just taxes themselves. And particularly, one is the amount of property turnover that we'll see. More than likely, investors, now that they have grandfathered arrangements in place, they'll want to keep the property as long as possible. And then because there's such a high cost associated with exiting the property, they're going to be more reluctant to sell. So imagine you have a number in mind. As an accountant, you probably think, I want to net, say, $1 million out of this asset. And now that the cost associated with exiting is going up, you're saying, I have to hold on to it a little bit longer before I net that much.
That's right.
So you're not going to sell it. And then as a result, fewer properties are turning over. And one of the other impacts that I don't think that many other people have addressed, but it's the state government revenue. So state government, fewer properties are turning over. Therefore, there's going to be fewer instances of stamp duty being paid. Therefore, state governments are going to receive less. And if they are being purchased by first-time buyers, owner-occupiers, then less land tax.
Yes.
State governments from state to state will receive less revenue. And then what's the impact of that going to be?
That's right. And look, obviously, hopefully that doesn't have negative connotations outside. You would tend to think that there'll be some sort of pass-on effect there as well.
Yeah.
And I guess we'll wait and see on that.
Yeah, it'll be simple. Either state governments spend less or they charge more tax. So stamp duty will be higher for owner-occupiers potentially because there's going to be fewer investors. Investors might not buy property because of the higher cost of entry. Rents are going to go up because there's fewer investors making rental properties available. It's economics 101, like supply and demand. Yeah.
Johnny, I want to take it back also. What do you think, given all these changes, what are the things that we need to bring our loyal clients to in terms of fundamentals? I'd love to start with yourself, like in terms of what are the fundamentals, like 2 to 3 things that you want to really bring it back to that sort of stands the test of time?
I think it's working with financial service professionals like yourself. Don't you think you take stock, these are my assets and liabilities. What do I need to do to get to my goals? Because for me, once I've purchased an investment property for you, it's an annual call to say, hey, this is how your property is performing. It's achieved this much capital growth. It should be getting this sort of much rent. Let me hassle your property manager. Make sure you speak to your mortgage broker about reviewing your loan and making sure it's structured and, if necessary, refinance or get a lower interest rate now that your LVR is lower. So it's really about taking regular stock and touching base with mortgage brokers, accountants, financial planners, and the other members of your financial services team to get you closer to your financial goals at the end of the day.
Jenny, you were also mentioning to me, and I found this very interesting. You have a sweet spot of how many clients you like to maintain
Yeah.
to give them that personal attention.
Yeah.
I think also with a number of professionals entering the market, professionals market also is growing in numbers. People are obviously seeing that as an opportunity to do business. What do you think of the sweet spot, and how do you know? You mentioned one call, obviously for existing clients, but is there a theory or an ethos, and what do you think is the value of having that personal interest from the client?
Personally, I'm very high touch. So a lot of people
Yeah.
come to me, they're relatively inexperienced. And I think people in general are relatively inexperienced when it comes to purchasing property. They're not buying property day in, day out. If you think to go back to your life cycle, you're not buying very many. The average person isn't buying very many properties across their entire life cycle. They might buy their first home, their family home, they might downsize, maybe a holiday home, maybe an investment property. So at most, maybe 5, 6 properties in their lifetime.
Yep.
So they don't have a great breadth of experience. But like for me, I'm averaging 2.5 properties per month on average. And I only take 7 clients on board at a time because my clients are relatively inexperienced. They may have purchased one property before, or they might have purchased one investment property before, but they expect a high amount of touch from me. And therefore I'm limited in terms of how many clients I can take on personally. And I'm sure with yourself forming those relationships with clients as well, that you'd be limited as to how many clients you can take on as well.
Yeah, absolutely. And so the way we look at it is really that we have a number of clients that we understand their situation of, and we stay in touch with them. It's really a strategy conversation. So they may not, like we may have even 40 clients, let's say, that we work with at any given time, but none of them are actually going to be maybe doing something this month. We might get a referral that comes through, and that would be something new that comes in. But when we're checking back in with these 30 to 40 clients, we're saying, if there's been changes in the market, do you understand the changes? Have there been any changes to their situation? It's more around, we understand last time we spoke, this is where you were at.
Yeah.
Has that changed? Have we progressed? So in a sense, we end up being advisors from a perspective of how are they tracking to their plans?
Yeah.
Because obviously where we've had a more in-depth conversation, we've put out a plan in place. So we've said, from the looks of things, in 6 months from now, you're looking to get a promotion where there's probably an extra 20K coming in there. Your wife's going to be coming back into work. Yes, there's going to be childcare costs coming in. How do we plan for that? What are the lenders that can potentially support what you're looking to do in 6 months from now? And then what happens is, of course, the lenders change their policy. So it ends up, when that check-in happens in 6 months, it's us talking to them about, these are the lenders I know we had it on a potential list, and here are some changes that have happened.
Yeah.
So as brokers, and I'm sure you have this as well, with staying up to date with changes, for us it's all about the lenders, and we're always dealing with the lending community as well, and we get updates very frequently. And we like to also pass that feedback on to lenders as well. So as an example, Macquarie, for example, really values the channel. In fact, they feel like it's through the channel that they can grow. And so we're in a position where we can have, as the channel, pass on feedback to Macquarie in terms of their loan structures from real, actual stories from what our clients are saying.
Yeah.
And so there are the lenders, I won't mention them at all, but there are lenders that potentially feel like there's an opportunity to go for it on their own. And that's great. But you know what? They're the ones that have their overall funds under management have been affected by not respecting and understanding the value of the channel.
Yeah.
So that,
I think consumer feedback is important because there's the old trope, the customer is always right. So I think you are at the front face of your customer. You're at the front face of essentially the market. So you're dealing with buyers, borrowers, homeowners, and you're passing on that feedback to your BDM and the lender, and hopefully they adapt the policy within their risk parameters to say, okay, look, we've made these changes to address that feedback as well. How does it? So I definitely think that the role of a mortgage broker is very important in that respect because they can pass feedback up and down the chain, whereas just going to your bank or going to compare.com.au or canstar.com.au and just having a look at what the cheapest interest rate is not like the right way to go, I think, because you won't get that feedback. Like you're not saying to your BDM, oh, hey, this is the client situation. What can you do to address it? Yeah.
Yeah, I think in Australia, we're lucky that most of our clients respect that. And they understand that going to a CanStar is probably not going to give them the best result. I think they value the relationship, and a lot of relationships are still built on trust. And so it does take time to build that up.
Yeah.
But once you do get that, it is transferable. And I think if you get a good result for a client, they'll remember that.
Yeah.
And that's it's 101, right? In terms of getting referrals, I suppose it is getting them that good result and then staying in touch with them after that as well.
I think the other part of it is being a specialist in your field. Nobody has gone through, not nobody, but there's very few people that have gone through the volume of transaction that you and I have gone through. Like the average person hasn't purchased 2.5 properties a month or done 5 loans a week or however many you do. So that being said, like they can't move from unconscious incompetence to unconscious competence sort of thing, to the point where they're doing things without thinking, because they just don't have the education, experience, or exposure to the market to be able to move them around that sort of intelligence life cycle.
Yeah, absolutely.
Yeah, very good.
So
Thank you so much for coming on, mate. I really appreciate you taking the time to chat. If anybody wants to find out more about what you can do and how you can help them out, how's the best way to get in touch?
yeah, just jump on our website, Luval, www.luval.com.au.
Yeah.
It's probably the best way.
Okay.
And our details are on there for existing and new clients. And love to have a chat with you.
Awesome. Thanks so much. Really appreciate your time.
Thanks, Charlie. Appreciate it.